6%, and our amortization is 3%. So that means then we're looking here at year 0. In year 1, our loan is going to be reduced by 3%. So beginning in year 1, we have the outstanding balance of 100. But we're paying down, of that 100, we're paying down 3% of it. So by the time we get to the end of year 1, our balance is actually a little bit lower. It's 97. And in practice, what you should do is you take the average of the beginning balance and the ending balance to calculate your interest of 6%. So average beginning and ending. So we've paid down 3, so our balance is now 97, but we owe 5.9. It's a little bit less than $6 because over the course of that period, the principal went down. So we paid some down, and we don't need to pay interest on that anymore. The main point of we'll go back and we can actually cover the exact debt in this example. But what I'm trying to say is debt amortization is cash that you pay out of your pocket that reduces the principal balance on your debt. It's not interest. Does that make sense? So interest is what is the cost that you pay to the bank for taking out the loan. You're going to eventually have to pay back that whole loan in full. But interest is just everything above the amount of the original loan. The debt amortization is just paying down the loan. So your debt service, the amount that you pay to service the debt, is composed of interest and principal paydown. And so this part, we've already accounted for the interest cash expense here. Now all we're doing is accounting for the principal paydown here. I'm going to call this principal paydown. So all you need to know at this point is that interest and principal paydown are both two components of debt service. Together they equal debt service. So in this case, we're amortizing 3% of our original balance on our loan, so that equals $981,720 every year, year in, year out. It's a negative adjustment to our net income. So the line that says additional working capital needs, I believe in our case here, I believe the assumption is all the working capital accounts stay flat. Yeah, we're not dealing with this. Okay, so just please ignore that for now. Alright, so now we have total adjustments to net income after tax. We just sum these up here. So now we have total adjustments to our net income after tax of $707,000. So now that means the property generated cash flow of 501 plus 707,000 of $205,000. Yeah.
Why is the amortization not counting to the net income?
Because this is not an expense. You cannot expense the amortization. So net income only takes into account revenue and expenses. Mm-hmm. Amortization is it's just not treated as an expense. It's treated as a cash flow item. You're crediting, you're reducing your debt balance, yeah, but that's not an expense. Okay. The interest expense is an expense, but it's below NOI. So you see, yeah, in NOI, we don't want to take into account debt, depreciation. It's just and that the purpose of doing this way, of keeping interest expense, depreciation below NOI, that allows us to compare NOI of different property types, regardless of what the interest expense is and how much depreciation they have. Because this number here is kind of taken as an example of like what is the cash flow of the business, regardless of how much debt is on it, regardless of how much depreciation there is, because these two things can vary significantly from building to building to building, right? This one allows us to compare different properties against each other. The reason why they're below here is just so we can get to net income before tax, because you're allowed to take interest expense and depreciation to reduce your net income before tax. If we weren't allowed to do this, we would have a big net income. This would be subject to tax liability, right? But because we're allowed to reduce net income by these expenses here, we actually end up with negative taxable income, and they can't collect tax on negative income. So we don't pay the government anything in this case. And then, like we said, depreciation. We're allowed to reduce our net income for depreciation, but it's non-cash. So in order to determine what the actual cash flow out of our pocket was that year, we've got to add this back to net income after tax. This number does not take into account CapEx, because CapEx is not an expense, and it doesn't take into account debt amortization, because that's not an expense. So we've got to take into account these two cash flow items here in order to get real cash adjustments. And then that explains the difference between net operating income of $3.3 million and actual cash that came out of our pocket this year of $200,000. And I can share this too. So the basic progression is net income, net operating income, down to net income before tax. If in the event there's any taxes, you reduce your net income before tax, and then you get net income after tax. And then what we've got to do is we've got to adjust that to take into account cash and non-cash items that are not accounted for in net operating income to arrive at operating cash flow. And you can see operating cash flow is just net income after tax plus all the adjustments we're making here. These three.
Why did you say that amortization is not included in, like when you calculate net income after tax?
So amortization is just not an expense. So it's just not treated as an expense in accounting.
Okay.
It's treated as a cash flow item. You'll never see debt pay down happen up here. You only see interest expense.
But that interest expense, is that the interest expense referring to your debt, or?
Yes. So I think what we could do next maybe is go into the debt service, because it sounded like there was a little bit of confusion around that. So this will hopefully explain it. So all right, we've got debt, right? What does it say? Our debt assumption, okay, so we purchased this property for 54 or 5, what's it called? Aggregate purchase investment. Purchase this property for $54.5 million, right? But we're not gonna take $54.5 million of our own money, which is called our equity, and buy this property. We're gonna take out a loan from the bank that's gonna help us reduce this price, reduce our contribution to this purchase price. So In our case, we're able to finance 60% of the cost of the property, so that's mortgage debt as percent of purchase price, which is 60%. So our total mortgage is 60% of the purchase price. That means we're only contributing out of our own pocket 40%. So our total mortgage is $32,724. So the way to think about this is you have a beginning balance, you have plus loan amount, then you have less amortization. So it's just pay down of debt. And then you have ending balance. Every year. It's just the way to think about it. So in year 0, we take out this loan of 32. We don't amortize. Whoops, we don't amortize anything because it just occurs at the end of the year. And our beginning balance in this case is 0 too. So that means the sum of all these at the end of year 0 is just 32, the amount that we took out. Over the course of year 1, however, so we begin year 1 with the ending balance from year 0. In year 1, we don't take out any additional debt, so this amount is 0. We're not adding anything. However, we said that annual pay down percent of total mortgage is 3%. And it's also a good thing to do when you have these, when you have these hard-coded numbers to make them blue so you know that they are the inputs. These are inputs, and these are formulas. So black is formula, that means it's linked somehow, and then blue is an input, which means that if you change this, if you change this to 50, for example, this is going to change, and it's going to flow through everything. But let's leave that at 60 for right now. So annual pay down as a percent of total mortgage is 3%. Annual pay down dollar amount is just 3% times our total mortgage. So that's where we got that. That's where we get the 981,720. So that means that every single year, out of this original debt balance, we're going to pay down 91,8720. So at the end of year 1, you see what happened there? Our balance is reduced by the amount that we pay down. Year 2, same thing. Right? We got ending balance. For now, our ending balance of year 2 is our beginning balance of year 2 is our ending balance of year 1. Again, we're not adding anything additional to the loan, but we are amortizing it down again. We're paying it down. This is cash that we pay down. We retire the loan. So this balance keeps getting smaller and smaller and smaller. This is not an expense. This is just cash pay down of the debt. The interest expense is what we recognize on the income statement below NOI. And in this case, what do we say? Our interest expense interest rate on annual debt is 6%. Sorry, I just want to see one thing. So interest expense. So year 0, we take out the debt. We don't pay anything. The interest kicks in year 1, after 1 year has gone by, and we owe interest on top of the amount that we're paying down. So it's 6%, right? So 6%. And I want to sometimes 1963. Okay. I think what he's doing is just taking this balance and stuff. Yeah, okay. So what Frank wants you to do is, this is like a worst case scenario, which means you're paying interest on the beginning balance. You're not getting any credit for the amount that you pay down. So 6% times the beginning year balance is our 1963. Now, as our amount of debt goes down every year, so too will the amount of interest that we owe, because the interest is calculated on the balance. And as this goes down, we're going to owe less interest every year. And so debt service then, total debt service, debt service is going to equal the amortization that we pay down plus the interest expense. So we don't owe anything at year 0, which we'd expect. And then we owe, it goes down every year, because this amount that we pay down off the loan is fixed, but this amount, the interest that we pay, this is the expense that is reflected on the income statement, goes down because we're paying down the debt every year. We owe less interest. So our total debt service is interest plus amort. See that? So what we've done is, and this is how you should set up pretty much all your accounts, and this is how you should think about things, right? It's a change from year t to year t plus 1, from year 0 to year 1. You start with the beginning balance, you adjust it for anything that you add to it, you adjust it, negative adjustments for anything you subtract from it, in this case our debt amort, and then you arrive at the ending balance for year 1. And then you just start. That's the great thing about Excel, because you can just copy this over. You just start, you do the same formulas for year 2. And then in the event, say like the bank came back to us and said, oh, actually, you're going to get a 5% interest on your loan instead of 6, we can just change that one blue cell here, and that automatically filters through and changes all our formulas for each year. Just because we're able to do that. Does that clarify some of the confusion around the debt? The difference between interest and amortization? There are two components of debt service, but one is a cash flow item, amortization, and the other is an expense item, interest. Yes, I'll show this compass. Yeah. What do we say? Oh, yeah, this is cash flow adjustment. You talking about CapEx?
Right.
Yeah. So, in every year that it occurs, you subtract it.
Every year.
Yeah.
But it says that it will take like 7 years for the. Oh, that's
For the
not
depreciation.
Right.
Do you want to go over the depreciation schedule? How that works?
Sure.
Okay. Let's do that. So the same way that we did for debt, you can also do for depreciation CapEx. Alright. Did he give you? He gave you guys a balance sheet, right? Income statement, cash flow, no balance sheet, no balance sheet, right? Yeah, we're not doing a balance sheet. No balance sheet. Yeah. Okay. Anyway, so thinking about it the same way that we just thought about for debt, you have a beginning balance,